Once you start to get into the alternative asset space and you start to look and you dive in private equity that you don't get in the public markets, right? Because it's that early access that you're really looking for. And then you also get to see the reports that the private equity companies are giving you, how that hands-on value creation is working by the companies that are doing it. So there's tends to be a private equity manager that puts the money into one of these private companies and then helps you grow a portfolio. So I'll go into more detail later about how all of that works structurally. If you're investing directly with one of the companies or you're investing through a manager or a management entity. But in general, that's what you're trying to do. You're trying to get operational improvements. You're trying to get more scale. You're trying to get early access. And those things are going to help you grow your portfolio more quickly than you would if you were just buying a traditional stock on the stock market. And then after private equity, you want to start to look at private credit, right? If you've been reading financial news over the last couple of years, you've really seen a boom in private credit. And private credit, the reason for that is when there's volatility, not just in the public markets, or there's uncertainty with the geopolitical situation, people move to a lower risk position, right? So private equity is higher risk. Private credit is theoretically lower risk because you're in a better legal position in the priority of the capital stack. So that means that if the company loses money, the people who are equity holders lose the money first. People who are the private credit holders are going to lose the money last. And so there's been a shift where investors are putting their money with private credit asset managers. They then go out and give the loans to the private equity companies so that they can continue to grow. So you're getting exposure to the same types of companies, but in a different position through a different vehicle. So the key benefits of that are the capital preservation, and you should be getting recurring income. So instead of like the private equity where maybe you invest some money and you hope that they're going to go IPO or there's going to be some secondary market for you to sell your equities into, the private credit allows you to have a structured position where you're getting a recurring income and your principal balance is protected and guaranteed by that entity that you've loaned the money to. The issues that come up with private credit, though, because there still are risks, are how good was the underwriting of that company? What was the money used for? How strong are the contracts that are underlying it? So you have a little bit of give and take. You're getting a better risk position. You're getting some income, but you're not going to see that same level of growth because it's just a repayment of principal plus interest. So then we can get into the third piece of it, which is the private real estate. And with private real estate, you get the best of both worlds because you're not investing in a private equity company where you don't know what the operational performance of that company is. You're getting a tangible asset. So you have some level of tangible asset risk protection on the downside, unlike private equity. So even if you're in an equity position, you hopefully have some cushion in there. And then secondarily, you can get recurring income from real estate. And that doesn't matter if you're getting into industrial or multifamily or self-storage, whatever the case may be, you have an opportunity to generate income from it. So you get private equity opportunities where you have a level of growth that could be far exceeding the market. You have tangible downside risk protection with a physical asset, and you have the opportunity to have the recurring income just like you would with private credit. And on top of all of that, you get to have the ability to put leverage on the asset itself. So putting leverage on a private real estate asset lets that return on the equity side grow even greater. So the lenders in the market give you a loan, your equity grows, and your principal balance stays the same. That's really the key benefit of getting into a real estate asset, is that you get that outsized growth on the equity component, but the downside risk of having the physical asset.
This video is for educational and informational purposes only. It is not investment, financial, legal, tax, or accounting advice. Nothing in this video constitutes an offer to sell or a solicitation of an offer to buy any securities or investment product. Any offering, if made, will be made only through official offering documents and in accordance with applicable law. Any examples, projections, or assumptions are illustrative only and not guarantees of future performance. Past performance is not indicative of future results. Investing involves risk, including possible loss of principal. Real estate and private investments may be speculative and illiquid and may not be suitable for all investors. You should conduct your own due diligence and consult your own licensed advisors before making any investment decision. The presenter and affiliated entities may have financial interests in investments discussed. All information is provided as is, with no warranties as to accuracy or completeness.